What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is March 1st of 2023. Well, folks, I hope you all are having a fantastic day wherever you are and a great start to the month, because in today's video, we're going to be talking about something really critical when it comes to Bitcoin that I think the vast majority of investors and traders are not really considering at the moment, at least those who are feeling the FOMO. If you are in that camp right now, I hope you guys will stay tuned for today's video, because I think we're going to really put things into perspective, whether it be through Bitcoin's price action or taking a look into the broader macro analysis. We've got a lot of things to dive into in today's video. If you guys happen to enjoy it, consider dropping a like. It's one of the best ways you can support the channel, and let's go ahead and kick off the rambling. All right, so I want to go ahead and start real quick, as we usually do, by talking about Bitcoin here. And today I want to really try to get down to the numbers. We usually talk about whether or not we're bullish or bearish, and talk about the general trend metrics, momentum indicators, or price action itself that can signify whether or not we lean in either camp. But one thing I want to do today is get a little bit more into the numbers and really talk about probabilities, and on top of that, really what you have to gain by taking either direction on the trade or focusing on either form of the sentiment, meaning being bullish or bearish. Now, I want to go ahead and start by just playing devil's advocate here, showcasing the other side of the argument. What is there to lose if we don't go long Bitcoin here? Right? What could we potentially make, whether it be a short-term trade into some common levels of resistance that even some of the bulls may agree we're going to hit, as this may be a short-term relief rally in their mind. But some people also are in the camp that we're in a full-scale swing bull market. And I want to go ahead and talk about that here, right? So we have rallied off of what may be the lows of the bear market, as these bulls are arguing, and from that thesis we've already missed a good little chunk here from those lows, coming up from around 15,500, which I would bet most people did not get the absolute bottom on. But again, playing to this point, from the absolute lows we've come up about 53%. So we already have to accept that we missed that if this is the scenario. Now, if we continue through, there are two different setups that I think people are eyeing here. Some are eyeing a move above the 200-week moving average, which come up to about 15% here, roughly speaking, give or take a couple percentage points. Or people think this is going to yet again be another relief rally, and one that'll trap a lot of traders, but is one to materialize on and make returns on. So there you go. You've got a potential upside case there in the short term of 15%. But I think the real long-term thing we don't want to miss on, and we're very vocal about here on the channel that we're not going to miss, is the broader next start of the next bull market, right? If there is going to be this next move, there's going to be this kind of major upward swing where we go back to the all-time highs and we start to see a long-term uptrend, we definitely don't want to miss that, because you've got high degrees of upside where we'll probably pass the previous all-time highs and go towards new all-time highs, potentially towards some of those levels like 100K. That is what we do not want to miss. And as a swing trader, macro trader, I'm not going to miss those things. However, it is important to note that we are going to need to see things happen before we get to that position. And what is that going to be? Well, it's going to be turning the 200-week not into resistance, but into support, getting back above that range, holding above it, and really starting to showcase a pattern of higher lows and higher highs. I'd much rather pay a slight premium from where we sold around 24, 25K if I've got trend confirmation, if I've got the sign through market order flow, through the FOMO and the air that you can feel, the optimism, and most importantly, the narratives that are going to drive the altcoin cycle and predominantly the overall optimism in inflows versus outflows into crypto assets like Bitcoin, Ethereum, and the likes of our favorite altcoins. That's all I need to see. I need to see those setups, because if I don't see price action giving me that confidence that this range, this accumulation channel we've been in since back in June, or at least that's what the thesis is for the bulls, right? We're just going along with this narrative. If I can't see that that's turned into new support, and if I can't see patterns of higher lows and higher highs above that range, I'm going to think we're in the short-term case scenario. Again, the deviation here, which is going to get eventually shot down. If we get back into this pocket after popping up here, folks, I got to tell you this, I would not want to be caught holding positions. I would get out even if I had to take a minute loss, right? And that's again why we're not chasing this trade here, because it's likely this is going to chop right back down and do what it did back in November during the collapse of FTX. It's going to deviate right back down to this range. And as we talk about the macro indicators later on, if you guys don't believe that that can happen, that there isn't the firepower on the sell side to be able to do that, well, I got to tell you guys, I think you got another thing coming. The reason I have to be so vocal about that is because I've been observing that market order flow, and I'm observing the price action. And when we take a look at our partner tool bookmap, which you guys can get access to in the link down below in the description, they do have a free trial version where you guys can kind of get a feel for the platform. But one of the features that they have that allows us to get some insights that are difficult to see for the broader market participants is its multi-book feature, where we get to see the big weight of market order flow through cumulative volume delta. Now they have a ton of other things such as their liquidation tracker and market pulse, which was a recent feature that they launched. Some really cool stuff that can help give you an edge on markets that I personally use. But for the purpose of talking about it here on the channel, I want to focus in on that cumulative volume delta. It's market order flow. It's analyzing across some of the big exchanges like Binance and Huobi, where there's a lot of that spot volume, as to whether or not we're seeing more buyers or more sellers. Because sometimes price action can be deceiving. We need to look beyond that and track the actual forced buying or selling in the market, where people are not waiting around and they're looking to change from one position to another, either in cash into Bitcoin, which would be positive cumulative volume delta or market order flow, and vice versa. If there's a lot of selling, market order selling of Bitcoin into cash, that is negative market order flow or negative effect on the cumulative volume delta. And we can see here over the last 7 days, as we always analyze it here on the channel, we are down 11,000 points. This is typical distribution 101, where prices have been propped up into this range since back in January. And since then, even though we've had some moves here in price that have been optimistic for a day or two, that market order flow flips dramatically quick. And it has been, on average, red after red after red over the past couple of weeks, and really over the past 2 months. So the key point I want to drive here is to not be deceived by this move. The volume is incredibly thin, and there's a lot of easy ways to manipulate price in the short term in order to lead it in either direction when there's thin trading on the order books. It's a very, very important dynamic, especially with the kind of disassociation where a lot of the volume, which should be on spot markets, helping to make Bitcoin more liquid and find real price discovery, is going on in derivatives markets, the leverage trading exchanges that so many content creators out there are promoting, hoping that you'll get liquidated so you can make the money essentially off of your losses. That's how the game works. And that's why they're getting pushed all the time in the space. It's why we don't talk about them here on the channel, because I don't want you guys getting liquidated. I want you guys to be able to dollar cost average in and make a solid entry into real capitulation when we actually find bear market lows. And as we did back during August, right, we took advantage of that relief rally in the exact same range here. I want to go ahead and make it clear that this kind of like additional pop-up high here, this deviation, doesn't have to happen. We can start rolling over much sooner than that. And I'm going to talk about why that is, not only because of the negative market order flow, and this plays into our more kind of bearish thesis about coming down into this pocket where we were back in November during the FTX collapse. We need not look further than the macro perspective of what's going on in equities. Take a look at the Dow Jones. Now, as we've seen people, kind of cheer on over the past couple of months, really since backing in Q4 of 2022, a lot of people are pointing towards the Dow Jones, the defensive stocks, doing incredibly well. They had a really significant surge of about 20%, the biggest relief rally, or at least the biggest move that we had seen from a low in the bear market so far, over 20% move. And a lot of people thought this was the return to the norm. And a lot of people started building positions, getting in on the trend. And the one thing we advised is if we're not seeing sustained higher lows and higher highs, then we got a problem. And this is exactly what's playing out here. In fact, rather than continuing on the trend of higher lows and higher highs, seeing the defensive stocks, the large established companies, the 30 companies that make up the Dow Jones that pay good dividends, that have stronger financials, that have been generally doing quite well here over the past year, even though we're supposedly in a recession, well, those names are starting to fade. They are starting to not get above the same range they've been held down at since April of 2022. And on top of that, we've set in relatively lower levels here and are now potentially testing for a deviation back below the 200-day moving average, meaning that this was simply a deviation, yet again, another relief rally. The rule here is that although there is no absolute guarantee, it is incredibly likely that if we get back below that 200-day, if we cannot make that range support, it's still resistance. and that this was a fake out. And when there is a fake out, usually we move down to new lows. Conservatively, just going in line with the previous lows here, you can start to get an idea of where we're heading. And it does not look pretty. Another 20% move down in the risk-off plays. So then you have to ask yourself, the plays that did so well over the last decade, the tech stocks, the FANG stocks, the names that were doing so well during a high growth period, how are they going to fare during a period of risk-off activity? How are they going to fare in an era where the Federal Reserve is no longer printing enormous amounts of money and maintaining interest rates at near zero, but rather increasing interest rates to their highest level in nearly 2 decades, and on top of that, are tightening the monetary policy? They're not just sitting on their hands, they're really aggressively reducing the balance sheet, and that is going to absorb some of that excess liquidity that could have supported prices. Well, I gotta tell you guys, I think it's gonna be worse than this projection here of the Dow Jones. I think the NASDAQ and those stocks are going to fare really bad. And it's because of the certain dynamic here that we are in a risk-off period, and even if we are seeing the risk-off plays, like stocks that are within the Dow Jones, like Johnson & Johnson, the consumer cyclical defensive stocks, on a multi-week sell streak. It has been consistently, week by week by week, red candles here for names like Johnson & Johnson, Procter & Gamble setting in lower highs since back in January. Seeing these kind of trends for multi-$100 billion companies, which make up probably, I would say, around like 2 to 3 trillion in market cap if we were to talk about all the consumer cyclical stocks, Unilever, you name it. When these defensive plays, which adapt their prices to inflation, are seeing lower highs and lower lows, that tells you there is no safe asset out there other than US Treasury notes and, well, currency, putting your money in a bank account and getting some interest. That's the best play now. And it's very difficult to encourage people to invest in names, even defensive stocks like Johnson & Johnson and Procter & Gamble, who may even, for example, pay into a really nice dividend, about 2.9% at the moment with current prices, when the stock is making lower highs and lower lows. When at the moment I can go on US Treasury notes from different maturity dates and get anywhere from around 3 to 4%. Probably going to be 5% soon with the pace of expansion. We can see here on the 2-year yield, it's about almost to pay 5%. It's the highest closing level we've had on a weekly candle. As far back here as 2007, as it is tracking the federal funds rate. The dollar index, again, as we're projecting, there's going to be a lower high here than the prior time, most likely. Again, the Dixie has a history of coming back up to those highs. The dollar is strong at the moment. So if the Dow Jones and these stocks, these more defensive plays, the ones that pay dividends and have strong cash flows, are not doing so hot, why should we be getting bullish on risk-on stocks? Are we really in a risk-on environment? Do we have the excess money lying around, the FOMO and excitement to carry on another bull market? Do we have any narratives that we can hold on to like straws to just, hopefully have some optimism in the market? I don't want to be too bearish here, guys. I have no benefit from a business perspective to be bearish to you guys. All I'm doing here is being honest with you all. I would love for the bull market of the last decade to come back, but we are at the end of a secular bull market. And the exact same thing we are seeing here in the Dow Jones, a slightly relative lower set of highs versus the previous all-time high. It's exactly what happened back during the dot-com bubble. As we've talked about for months here on the channel, we had many retests where the Dow Jones would come up towards a similar range towards its previous high back in January of 2000. Over 20 years later, we are repeating history. Or 23 years later, we are seeing a very similar pattern that inevitably left us with flush down after flush down after flush down, where from the previous all-time highs, even the Dow Jones moved down 38%. And if we look back to history and observe what happened in the NASDAQ, how those stocks fared, well, I got to tell you guys, it was not a pretty picture. 78% from the previous all-time highs before we found a bottom. And many of those technology stocks never fully recovered until decades later. Till in 2015, a decade and a half later. You sure you want to be caught holding the bag? You sure you want to risk the money that you made during a period of easy money? Because I got to tell you guys, the cost of living's going up. Cash is needed right now. And on top of that, we may be very well entering into a substantial recession, the likes of which we have not seen in a long period of time. A real recessionary bear market where equities are going to drop 40, 50, 60% across the board. And I don't know about you guys, but that does not leave me optimistic for crypto at the moment. Now, sure, there are some really exciting fundamental plays out there that I like, that I think are really going to do interesting things, but it doesn't mean we can fight the trend. Monetary flows are what dominate the trend and are what are going to determine whether or not we're going to make money or not going long or lose money. Now, again, we talk about this a lot in the Dash report. There is some things to be optimistic about coming into the next year, really into late part of 2023 and 2024. When we get those bear market lows, there are going to be lots of exciting industries to look into. And this is, again, one of the ways where you guys can not only support the channel, but get a lot of additional insights beyond what we just talk about here on the channel. The Dash Report is a newsletter we run here on the channel. I talk about not just crypto markets, but we talk about equity markets, commodities, Forex, the whole macro perspective. And we have some exclusive indicators and tracking mechanisms for how we determine whether or not it's time to go long. We have some of our momentum indicators that we reference here on the channel. And you guys will get to know when I make my trades in the market, my general portfolio allocation, and what kind of altcoins or cryptos I'm going to be getting bullish on when the time comes. And this month we focused in on talking about some of the big industries and emerging industries and sectors that we're really bullish on going into the next bull market. So if you guys are looking for that optimistic tone, if you want to see me be a bit more optimistic and focus on the kind of big picture, kind of 10 to 50x sectors we're watching over the next coming years, then definitely check out this month's edition. It's going to be dropping later on today. So you guys can check out the link down below in the description, and you can get 20% off on that letter. But I want to go ahead and emphasize the really big economic data that we need to focus on. And that's what's going on in inflation and job opening data. Okay? Now, when we observe job openings, we need to see a continued decline to see that the Fed is in the driver's seat. For the past couple of months, since back in August, since the Fed really went tight on monetary policy, even with the Fed aggressively raising interest rates and setting that target rate higher, the labor market, which at the time had around 10,280,000 job openings, now has 11 million. And we think that the Fed is done tightening? Do we think that the labor market is softening? So long as you have a strong labor market, there is going to be negotiation power from the employee's side, which is going to lead towards higher wages. And as much as I like that generally, I would generally be rooting for this beyond reason and stuff. Like, I think at the end of the day, everyone wants the end consumer, or more specifically the end worker, to be able to have that negotiation power. Everyday people, right? The problem is you cannot have this happening during a period of inflation. If your goal is to get inflation down, and the longer we allow inflation to persist, this is going to get worse and worse for the end person, for the everyday worker. The cost of living is going to continue to accelerate until we get rid of the funny money, until we get rid of too many people who are over-leveraged, overexposed, and have unfortunately caused this excess demand versus supply. It is a monetary phenomenon. And that's, again, why inflation. Month over month, we had our biggest reading since back in June of 2022. Multiple months of progress being given up because the Federal Reserve is only starting to do 25 basis points. It feels like it's going to see whether or not the market agrees that inflation is done with. And this is the exact problem with the Fed. It's not in the driver's seat. It's not taking control of the situation. Well, markets are now starting to reprice that the Fed is going to have to do this. The bond market, currency markets, they're all screaming it because they know that the Fed are looking at these inflation numbers on the CPI and the PCE, and they're going, oh my gosh, annualized inflation didn't even budge. And this is easily going to take, continuing the course that we're on right now, over the next 6 to 12 months to get down to 2%. If the Fed wants to do this right, if they want to repeat the 70s, they can do that. But it's going to be a lot more pain for equities, for crypto, and for everyone when it comes to our cost of living. I know it's not fun, guys. I know sometimes it can feel like it's a lot of the same, but we've got to be realistic. I'm not going to sit here and lie to you guys or say, oh, here's the next latest, greatest altcoin. Let's pump it. It's going to be so great. I mean, I'm not that kind of content creator. I think this is why you guys come here during the bear markets. Like, there's so many YouTubers and content creators out there who will come and go. There's a lot of great ones out there as well who are still creating content right now. So I'm not meaning to be negative. I know many of them, they're great people. But this is why we're here during the bulls and bear markets. We know how to survive it. So many people are only used to the good times. And if you can know when to spot real capitulation and value opportunities, you'll not only outpace the vast majority of investors, but on top of that, you're going to become a much better trader. Those who don't know how to navigate and be nimble to the environment are going to lose money. People who made some of the best returns during a bull market can end up being the biggest losers when it comes to a bear market. And I don't mean that as an insult. It's just reality. We have to be prepared to stomach both sides of the trade. We have to be on the Fed's side. And the Fed is not done tightening yet. Whether the Fed wants to be done tightening or not, it's not done yet. It needs to keep inflation down. Because if it doesn't, and inflation gets out of control like it was back a couple months ago and goes even higher, we are in for a heaping world of trouble when it comes to the global economy. And so much of what has been built up over the last century will become fragile to a degree we have never seen before. That's not some doomsday stuff. That's reality. That's loss of trust in the system. And we've already got enough fragility going on as we transition from more localized manufacturing from a traditional globalized system, as global tensions continue to pick up. Last thing we need is another wave of inflation and a panic like we saw back in the 70s, over 50 years ago. So anyways, guys, I know I rambled on a good amount here, but as I mentioned, there are going to be some really exciting plays that we can watch for in the space. One of them that I think is definitely going to be an essential player in the space when it comes to fixing so many of the problems that happened over the last 2 years in crypto during the last bull market and the preceding bear market is AngelBlock. Now, if you guys have not heard about AngelBlock, if you guys haven't taken the time to dive through the website, it takes a couple minutes. It is one of the few plays we are very excited about. They are a long-term partner of ours here on the channel, and it's founded by one of my great friends, Alex, who has been in the space probably as long as I have. He is focusing on building with his team a platform that is aiming to not only offer a lot of exciting deal flow and projects in this space, which is always interesting to me personally, but more specifically, they're not just building another dime a dozen launchpad. They're building one that utilizes technology such as tranches, community governance, and voting to be able to build a much better experience for capital raising, and more importantly, a new standard for how projects need to meet certain qualities and requests in order to receive capital. So one of the biggest innovations that I hinted towards here is AngelBlock's focus on tranches and its governance. These two technological factors are what make AngelBlock so impactful. Now, they just recently launched their token, so if you guys want to take a look into it, I highly recommend you guys dive into it. This is a utility/governance token for the native platform where you guys will be able to be active participants, get access to deal flow, and all types of other different utilities and benefits if you guys like the platform itself. I recommend doing your own due diligence on it. I'm not here to just show the token. I definitely recommend you guys go ahead, take a look in the white paper and understand what it's all about. But more specifically, I want to talk about the real use of AngelBlock. There's going to be a lot of exciting investment opportunities that come on there. And the reason why the quality of these investment opportunities are going to be much better is because not only are you going to generally have better founders with these checks and balances in place, but when you have the technology of tranches and community governance, this is going to allow for the investors to be in the driving seat, for the investors to be leading in the conversation, for projects and companies to have to work for your capital. One of the biggest problems over the last couple of years is that as crypto projects usually do a single ICO or some IDO or some form of capital raise, they argue that they have to do it all at once because A, they're a protocol, they're going to need more capital. And on top of that, this is a token offering. You don't really get to mint new tokens usually. So because of that, they usually raise enormous amounts of money. And during the last decade of easy money, that was the norm. $50 million, $100 million, sure. So long as you got an interesting white paper, so long as you have some MIT grads or team members on there that look exciting, the vision makes sense, sure, $100 million. Well, the problem is that without some kind of mechanism like tranches that come into play, where there's voting power for the end users and investors to choose whether or not they deserve certain portions of that capital, well, they could have all that money and they can run away with it. That has literally been the case, or the slow rug, so to speak. Even venture capital projects that sound official and authoritative, well, they too play the same game. Overpaying people, not meeting on promises. That's been the story over the last decade in crypto when it comes to ICOs and crypto altcoins. And now we have a chance to change that, where projects, for example, who raise $10 million may only get the first million or $2 million. 20% of the allocated capital, and the rest will be remained in a decentralized, transparent smart contract as escrow. And until the team meets on certain delivered goals, they're not going to receive the other 80% of their capital. They're not going to receive another 20% tranche and another 20% tranche. And guess who gets to vote on it? The community participants and the investors. This is very groundbreaking stuff for the crypto space. And it is why AngelBlock is going to be such a game changer, because it's going to allow us to spot the real projects, the ones that don't have time for BS, that actually want to build something exciting. So I highly recommend you guys dive into it. The AngelBlock Telegram is fire. There's a ton of great people in there who are just absolutely amped up for what's being built in AngelBlock, who I think have also been through the brutal experiences of rug pulls and a lot of the unfortunately scammy behavior in the crypto space, and they want to see something new. If you guys are interested as well to kind of get a feel for the AngelBlock platform, I recommend you guys take a look at the AngelBlock YouTube channel, consider subscribing as well, and check out the platform demo where Alex kind of goes through and talks about some of the different things you can find on the website. It's very similar to that of equity crowdfunding platforms, which I'm a big fan of personally, that allow you to have more transparency on a project. You can learn about the team, you can start to see what their goals are, the overall fundraising goals, and also those tranches about what they aim to deliver on before you actually receive the capital. So that's it for today's video, guys. I want to thank you all for giving me some time to ramble as always. If you enjoyed this video, consider dropping a like. It's one of the best ways you guys can support the channel here. I'm going to be here with you guys during bull markets and bear markets. Even though this is a difficult time, it's all about preserving capital, doing what's best for you guys, and thinking about the next step forward. When we get those real signs, we're going to strike on it, and we're going to make sure that we have the setups in place on the bullish side to make some serious returns. And if you can do that once or twice in your life, well, you're going to be set. And that's what I want you guys to be able to get to at one point or another. I want to be right at the end of the day. I don't want to simply trade with my emotions, or more specifically trade in what I just simply think is going to be best just because that's what I want. I'm going to listen to the market as any smart investor would do. And we have to be diligent and not fight the Fed. That's it for today's video, everyone. I rambled on long enough. Have a wonderful rest of your day, and I'll see you all in the next one. Take care, everyone.